Welcome, I'm Catherine Magana here with Greg Carroll, Rachel Ivanovich, and Steve Wolf, where we're here to talk about the markets, investing, taxes, and planning in general. And so here we are, it's April 25th, and Wall Street is on sell-off mode this morning. The markets took a big dive, but it looks like it's settled down a little bit, so we'll see where we end up for the day. But part of that was some of the reporting that came out. GDP numbers came out at 1.6, where the expectations was 2.5. So that obviously kind of spooked the market a little bit. And also looks like the Treasury yields are sitting at about 4.73 right now, which is subject to change, but it's obviously putting a little dent in the market right now.
Yeah, I think that headline is a little bit misleading because people are still spending money. The problem is that they're spending it by using credit cards. Mm-hmm. And their credit card debt is now really getting big again. And that's a problem, and it will continue to be a problem as time goes on.
I think there's a slowdown, a little bit of spending, looks like on cars and gasoline. Obviously, if people aren't traveling as much, or the price of gas obviously is factored into that too.
Well, as far as interest rates coming down, and this just seems like it's a conversation we've been having forever, Fed now looks like they're probably not going to lower rates, at least in the near term. So we'll see. I mean, right now you got mortgage rates at about, 7% or so? And I heard somebody on TV, I don't know who it was, said they thought that the norm now might be between 7 and 8%. And I think that's going to put a little damper on the housing market and probably the car market and just about anything else that's has interest rate issues with it.
Yeah, that'll definitely slow things down a little bit if the consumers maxed out on their credit cards and interest rates are up there. I was listening to something on the TV the other day about, there's the low-end consumer is struggling a lot more than people realize, but the high end is still doing quite well. And one good example of that is, did you know that you can go on an app now, and this app covers restaurants around the world, where you pay to get a reservation?
Oh,
and it has nothing to do with the restaurants. They're just making money off these reservations. And they were showing some high-end steakhouse in New York, $750 for a reservation for two. Yeah.
That's a lot of burgers at McDonald's.
That's not the food.
that's just a reservation.
And the gentleman who founded the company said that the average is about $100. That's still a lot.
Well, are these for some of these exclusive restaurants that you can never get a reservation?
Well, obviously the $750 one would be, but there's, reservations for all kinds of restaurants that aren't that exclusive that are, $50 to $100. And I think when he designed this company or thought about the company, he was assuming they would make $25 per reservation, but the average is 4 times that now. So apparently he's doing quite well.
Yeah, it's a lot for reservation.
That is a lot.
It's also interesting because as I was been reading here over the past couple of weeks, that a lot of people have decided to eat in and not eat out. So if now you're going to charge them to reserve a table, the average person isn't going to do that. So this obviously has to be just the
this is
highest
the higher
end.
It's definitely
and
the higher end.
Probably the idiotic large cities that can do that.
Yeah, and it's funny because we were locked down, we were eating in during COVID, then we did the revenge spending coming out of COVID. Everybody went out. You couldn't get in any restaurant, right? But I think it's much easier now. I've been going to a couple of restaurants, and by 7:30, it's empty on a Friday night.
Right. Well, I know, Catherine, you said the market is taking a dive today, and it is a little bit, today being April 25th. What I'm noticing is that some of the tech stocks are down, but interestingly, even those tech stocks that are down say they're going to continue to buy the AI-related supplies. So those stocks are actually up. And again, this isn't a recommendation, so just don't go out there and buy anything that's AI. And if you do and you lose money, don't come back to me.
But year to date, the S&P 500 is still up. The Dow Jones, even if there's a pullback, we're still up for the year. So I think obviously, yes, we want it to be the end of the first quarter where everything was, rosy, but the reality is we are seeing a shift and a pullback.
Well, it's interesting. For the last year or two, the indices, like the S&P 500 or some of the others, they're just being dominated by a few stocks. Yeah. And it really isn't telling you what the market is doing. It's telling you what maybe 5 or 10 or 15 stocks are doing. That's a big change from what it used to be. And I think that a lot of that has to do with people who've gone to passive investing. So they're instead of investing in particular companies, they're investing in an index. And of course, Vanguard made that very popular, and they said how low cost it is. But I'm wondering now if maybe going the other way might not be a little bit smarter.
So it's interesting. I saw this week that Goldman Sachs is ditching their robo investment arm. They're selling it to Betterment. So here we are. One of the big companies is making a shift, and I know. Back several years ago, everybody was shifting. They wanted to jump on the bandwagon, but the reality is, who's your clientele? Who are you serving? So I thought that was kind of interesting to see that come through this week.
Yeah, I think like Steve was saying, the robo-advisors aren't getting the advice to their clients during times like this because it is confusing where the market is selling off and people are confused. They don't realize that it's only 10 stocks driving half the returns. And there's going to be a lot more volatility the rest of this year coming up with the election. And, every time, the Fed's going to speak, what are they going to do? Lower rates, raise rates? I mean, that's all over the board.
Well, and that kind of goes right into the CNN Fear and Greed Index is now at a 40 reading, which is clearly in the fear category. So we've gone from extreme greed about 2 or 3 months ago to now we're in the fear, heading toward extreme fear. It's kind of interesting how the emotions have played on this market.
I thought it was just a couple of weeks ago you said it was extreme greed, wasn't it?
It was in the greed category.
Oh,
but,
greed, not extreme greed.
Not extreme,
Gotcha.
but we're moving away from the greed part to the fear part. And as we all know, fear creates markets going down much faster than greed does, bringing them back up again. However, going back to the markets and indices and all that, the companies that are solid companies that are making good profits every year, those are still companies you want to own. Stock prices go up and down, but a price doesn't necessarily represent the earnings. It does to a point, but sometimes the prices get way out of hand both on the top and bottom end. So really look at the earnings more so than the price of a stock if you are going to buy into it or sell it.
So going back to our discussion on kind of Goldman Sachs ditching the robo-investing, I see from when we work with our clients and those that are phasing into retirement and also they need some cash flow planning or distribution planning and then also looking at the taxes. So it's sometimes it's not just what investment am I doing? It's like what's the purpose of the money? What's the best way to use the money? How should I invest it? How should I take distributions? Obviously, there's the tax part of it too.
How do I pay my taxes once I retire? Because it really changes from when you're employed and have a W-2. When you're employed, your employer withholds the taxes, remits it to the government, et cetera. But then once you retire and you start taking Social Security, you have a lot of passive income, you take distributions from your IRAs, you have to work with an advisor to ensure that you're paying in not too much so that you're getting a huge refund and not so little that you owe a lot of money, but just the right amount. And I mean, they being the government have safe harbor amounts, and you want to calculate that year by year because depending on what the market's doing, your investment income may fluctuate, and therefore your overall income. And this year, the number of refunds really that was paid out, or the people that received refunds, was down by 3.3%, what I thought was really interesting. But it really has to do, a lot of the articles I've been reading is that the IRS changed the way that withholding is on W-2s and how it's calculated. I don't know if you've seen the new W-4, but it's really confusing of how to fill that out. It's almost like you have to do a mini tax return to figure it out. And so people call and ask, can you help me fill this out because it is so confusing. But IRS.gov has a great tool for helping you figure out your withholding, but nothing can replace a great advisor.
Well, it's interesting because I think we were just talking today about a client who wanted to do things himself, and we offered to give him some advice, and maybe, Catherine, you can expound on that example.
So we have a client that came to us that inherited an annuity and came to us after the fact and took a distribution, and there's tax consequences. So there would have been some other options to kind of phase out that taxes and so once again, when things come up, that's what we're here for, is to really sit down and guide and go through the different options, because there are the tax implications of any decision that you make as well.
And it's really hard to plan after the fact.
Yeah.
So it's
Yeah.
better
So they came to us after, but we had offered before to
Right,
help.
but and in that particular case, it's like a $150,000 gain. So taxes on that they have to pay that they might not have had to. So when people say, "Oh my goodness, I can't believe I'm paying 1% to an advisor," that was
Wait
a lot
till
of
you
1%.
pay 40% to the government.
Exactly.
So
Exactly.
makes way more sense to meet with an advisor ahead of time.
Anything else going on in the tax world?
For some people, April 15th was 10 days ago, and therefore, had you filed with a refund, you'd probably be getting your refund right about now. So there is a tool on the IRS site, and the IRS has an app, a mobile app these days, IRS To Go, that you can check where's my refund. So you don't necessarily have to call your tax advisor's office to find out where your refund is these days. For San Diegans, we have until June 17th. To file and pay taxes this year. Right now, I believe is a really great time to look, if you're employed, look at your withholding, make sure you're structured properly, make sure that you're not paying in too much, make sure you're paying in enough, because we're only, 1 month into the second quarter. Look at, what your investments are doing to ensure that you've paid your first quarter estimate, which was due April 15th for everybody who doesn't live in San Diego County. But second quarter estimates are coming up in June. So that's really what's going on in the tax world right now, is just doing taxes.
Okay.
It's year round.
Well, very good. Well, that probably wraps it up for April 25th of 2024. And we'll see you again next week, whatever date that is. But I think it's the 2nd of
Yes,
May.
May 2nd.
All right. Take care, everybody. Bye-bye.
Please stay tuned for important regulatory disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Wolf Weezy Magana, LLC, doing business as WWM Financial, Savvy Doc Financial Planners, and Savvy Woman Wealth Management, is a registered investment advisor with the SEC.